Well, good afternoon, everyone, and welcome to the McKinley Carter webinar series, Behind Every Bear Market is an Opportunity, Smart Actions to Make the Most of the Second Half of 2022. My name is Brian Gongware. I work here at McKinley Carter Wealth Services as Director of Advisory Services, and I'm so pleased to welcome all of you in such a great turnout for this, our next edition in the webinar series. So thank you very much for joining us for today's presentation, and we're going to jump right into it. Wearing also the Chief Compliance Officer hat is that we have just a couple of notes and disclosures. Of course, this is not a solicitation. And know the performance figures that might be represented today include a composite. McKinley Carter is an SEC registered investment advisor, so should you seek additional information, ask for our Form ADV and other disclosure brochures, and we'll be sure to provide those to you. So our speakers today include myself, Brian Gongware. As I mentioned, I'm a principal here of McKinley Carter Wealth Services and also Director of Advisory Services, working with all of our advisors in our different markets and our different regions in which we serve our clients. I had the privilege to also lead our Pittsburgh office and serve as the firm's Chief Compliance Officer. I've been with McKinley Carter now over 13 years since David and I came together. Prior to that, I had founded and led a firm called Net Worth Investment Advisors, also here in Western Pennsylvania. Joining me, as you see on the screen and on the camera, is David McKinley, who serves as the President and the Chief Investment Officer here at McKinley Carter, with nearly 30 years of professional investment management experience, and also serving on the West Virginia Public Investment Fund's fiduciary committee with over 20 billion of assets in which they serve there. So a deep group of folks and professionals with myself and David, and look forward to sharing some of the insights that we have as far as the year is concerned. But with all that as a background, is our advisory team is a broad one. And just some of the pictures that are captured on the screen is of our advisors who serve in our different markets of an estimated 700 years of collective experience across our 50 plus employees, including our advisors. In the past, we've been fortunate enough to be recognized by CNBC, Pittsburgh Magazine, and West Virginia Executive Magazine, Investment News, and others, such that it has given us the opportunity to work with people like many of those folks who are joining us today, and having about $2 billion in assets under management today as a firm. But with that, let's get into our agenda for today. So we have prepared about a 30-minute presentation, followed by an optional question and answer session that we welcome you to join. We invite you to send in your questions throughout this session using the chat function, which can be found in the upper right side of the screen, in which you might be checking in and joining us today. So while your cameras and audio are not enabled for the various participants, we will be able to follow your chat requests, and we'll do the best we can during that Q&A session to address any additional things you might like us to talk about. So from today, as you saw in the invitation, is we're going to address what's happened in recent months. How can I assess if I'm still on track to meet my financial goals? What steps might we take now in understanding of the bear market and what we've experienced in the first half of the year? And what questions might I be talking about with my advisory team, whether that be at McKinley Carter or those who might not yet be clients of the firm, as you talk with your advisors. So with that, I'm happy to get us started. So why don't we go ahead and get started? So David, please begin by sharing a little bit of your observations from the first half of 2022 and some of the outlook for the second half of this year.
Very good. Thank you. Appreciate the introduction, Brian. I'm glad to be here with everyone. Looking back to January, 2022 has been an interesting year. The economy was strong, unemployment was low, earnings outlook was good, and equity valuations were reasonable. They weren't cheap, but they were reasonable. We were finally putting behind us concerns about the COVID pandemic, and economies around the world were reopening. But like in the spring of 2020, when we experienced a period of disequilibrium in energy prices, in energy markets, I should say, where demand fell quickly relative to supply, in January, well, called late 21, early 22, we actually were on the other side of that, with demand much higher than supply. That situation had begun to drive energy prices higher and inflation as well. And in fact, inflation is some 30 to 35%. I'm sorry, energy was 30 to 35% inflated and had a significant impact on those inflation numbers. But then on top of that, In February of 22, Russia attacks Ukraine and further disrupts the energy markets and other important commodity markets. It led to, in April, inflation hitting a 40-year high, an annualized rate of 8.5%. Again, much of that attributed to energy prices. In June, the Federal Reserve, in response to that, hiked interest rates again, but this time by 0.75 of a percentage point, one of the largest hikes since 1994. Brian and I both recall that early in our careers. It's been 28 years, passed quickly. But over the course of the first half, a lot of destruction took place in the financial markets. But in reality, not much has changed. The economy continues to expand, but at a slower pace. Earnings outlook is attractive, particularly for large cap US and, interestingly, emerging markets around the world. And valuations, if you like stocks back in December, you got to like them a little better now because valuations are so much more attractive for both stocks and bonds. But let's keep rolling. I mean, as we think about stocks in particular, equity markets throughout the first half of 22 have been a real roller coaster of ups and downs. You know, there's been a lot of cash on the sidelines for the last couple of years, and after declines, as you can see, this rotation of valuations, after the last couple of years, this cash began deployed. Bargain hunters were putting cash into equities, and they clearly were driving prices back up. But as we wrapped up the first half, ultimately the sellers outweighed the buyers, and the net impact has been a decline of more than 20% year to date, a true bear market. While the extent of this year's decline has been more significant than expected, putting it in perspective of the last 5 full calendar years produced a cumulative return of more than 100%, actually closer to like 115%. So a reversal of some sort was not entirely unanticipated, and in fact, some would argue is maybe even healthy. It's not unusual. Equity returns in 22 may have felt extraordinary, but really weren't all that uncommon. In fact, if we start taking a look at this chart and we start breaking down, the bar charts, if you will, reflect the annual returns over the last 40 years in the S&P 500, large cap US stocks. If we dig a little deeper, the red dots reflect the maximum intra-year decline. And if we look at the aggregate information over the last 40 years, the average intra-year decline drop in equities has been about 14%, with quite a few, like 2022, in excess of 20%. But overall, annual returns were positive in more than 75% of those years. This kind of significant downside volatility in equities is pretty typical every 5 to 10 years. Triggers emotions like fear and the desire to immediately reduce risk. But in the midst of upside volatility, which is a part of every economic cycle, markets can also trigger greed and the desire to increase risk. These extraordinary markets, both up and down, can challenge the conviction of clients to their strategies. As humans, we want to buy when things are up and sell when they're down. And of course, we must resist those temptations. You know, in reality, it just reinforces the value of the conversations we regularly hold with clients, preparing them with a strategy well in advance of either extreme. What was more of a surprise to us was the combination of both equities and fixed income declining at the same time. Generally, these asset classes act as diversifiers and offset the risks of each. For a moderate growth portfolio with both stock and bond allocations, this year turned out to be one of the worst first halves in history. Difficult to absorb, but the upside to this decline is that fixed income valuations have declined to the extent that yields have risen to a level we haven't seen in 10 plus years. Although they have been very modest for years, and the reality is most fixed income portfolios are now yielding 3 to 4, maybe even 5%. They're much higher, and they're contributing much more to fixed income sleeves of portfolios. This chart, similar to what we showed around equities, kind of shows just how dramatic this fixed income sell-off was. Although the Federal Reserve had been broadcasting their plans to tighten, essentially influencing interest rates higher, both on the short end and the long end, few accepted the bond market to so abruptly sell off, pushing bond prices down more than at any other point in the last 40 years. This appears to have brought to a close a 40-year bull market in bonds where interest rates over time really had been declining, of course, with various exceptions, but over time, over those 40 years, rates slowly declining. However, there has been such a reversal in bonds. We don't think bonds should be avoided. We have been underweight bonds for years, but the yields are so much higher now, and for many are very attractive portions of their portfolios. We would not want to exclude bonds from our portfolio construction. And in fact, they often provide a great deal of stability and diversity to equities. So I think it's important for us not just to look back, but what do we see going forward? What's influencing our decisions about portfolio construction for clients? There's a variety of ways we can look at this. The strategy team and I, there are 6 of us. Brian and I are 2 of the 6. We get together regularly and we think through a variety of data points. Among them includes leading economic indicators. It's a monthly measure of manufacturing activity, business and consumer confidence, interest rate spreads, and a variety of other factors. And yes, as you can see in the chart, leading economic indicators are moderating, but are far from negative. If you look at the gray, the shaded areas reflect periods of recession over the last 20 years. Those leading economic indicators generally turn negative before you enter a recession, and we're far from that point. There are other factors that we're considering as well. Looking at forecasts of revenue and earnings growth. Interestingly, if you look at the chart on the screen, relative to 2021, revenue and earnings growth have both declined from where they were. But I think it's important for us to recall that in 21, those were comparisons to 2020 at the height of COVID-19 and lockdowns. So as we think about current numbers relative to historic norms, these seem to be very reasonable and they're pretty attractive for equity investors. If we take a little broader look at earnings estimates, you can't see it from the chart, but I can share with you that 2022, these numbers have softened a bit, but not materially. And in part because of a significant increase in earnings from the energy sector. That diversity in the S&P 500 helps client portfolios. And as you'll hear in a few minutes, we've actually been adding to our energy weightings and have been for the last 6 to 12 months. The 2023 earnings outlook have remained strong, particularly for large cap US, which is measured by the S&P 500 and is the largest portion of our stock portfolios. In fact, we think the market sell-off in the first half of 22 is more than reflective of the slowdown in anticipated earnings. In fact, maybe a bit overshot. So a big question for all of us is, will markets recover in the second half of 22 to reflect reasonably strong 23 earnings numbers for at least large cap US? We think yes, but we wouldn't be surprised if an eventual recovery is delayed into 23. If we keep moving and we talk a little bit about how has the rubber met the road, so to speak, we talk about the things that we're doing in portfolios and the things that we're monitoring, but how is it affecting client portfolios? In a typical, and I'll use moderate growth portfolio because it's our most common, but we have a wide range of client portfolios from aggressive to conservative. But if we look at a moderate growth portfolio, we've been overweight equities by a couple of percentage points. And that's been that way for a couple of years since shortly after the COVID bounce, so to speak, we had throttled back from 65 to 62% equities. Year to date for the year, a typical portfolio has experienced losses in the high teens, 17 to 18%. But honestly, that's after being up an average of 13 to 14% a year for the 3 prior years. Now, in the midst of all that volatility, we were proactively managing our equity and fixed income allocations. I'll give you a couple of highlights. The things that we did and things we have done over the last year or two and things we've done more recently and the ways we believe we're prepared for the market ahead. In equities throughout 21, we were reducing exposure to IT and other we'll call growth-focused assets. We were concerned about their valuations and the outlook for continued appreciation. And in fact, we were concerned about the risk of declines. A typical tech asset, by the way, has declined by significantly more than the S&P 500. We're pleased with that move. What essentially we were doing is we were trying to bring portfolios into greater balance with value, which focuses on energy, manufacturing, industrial companies, even financial services, with an added focus on high free cash flow and dividends. In 22, more recently, we reduced our international equity exposure. We were concerned about international outlook due to the very strong US dollar, which happens to be at a 20-year high. Of course, the impact of the Russian attack on Ukraine and continued disruption to energy supply. In the fixed income space, I need to stretch the time horizon a bit more to put things into context. In 2020, we had been overweight to treasuries coming into the COVID environment, and so shortly thereafter, we reduced our emphasis and essentially allowed us to realize the benefit of that hedge during the COVID-19 downturn. It worked out wonderfully. We used those proceeds to buy higher yielding but high grade corporate bonds. In 2021, when we were concerned about rising interest rates, we actually began to shorten durations, essentially reduce the sensitivity of our portfolios to interest rate movements. Most recently, literally and measured in the last few weeks, in mid to late June, we reversed course and started extending durations because we saw an opportunity to produce higher yields for clients in their portfolios and believed that the risks around long-term interest rates were lower today than they had been previously. I'd like to share with you a glimpse into our current thinking. Those that have been clients of ours for a time, you'll be familiar with our decision points. The 6 of us that guide our investment strategy orient around 7 key points. And they're a subject of great debate among our strategy committee, and they guide all of our portfolio construction decisions. The first 5 points focus on equities and the last 2 on fixed income. And as you kind of work your way through there, you can see where we currently are and what are reasonable bounds and how we are deviating, if you will, from our strategic allocation. As shared in our last slide, the most significant changes in recent months were the extension of duration and the reduction in international equities. I have to comment, considering the very high value of the US dollar relative to international currencies, and to be perfectly frank with you, and the relative strength of international economies, I wouldn't be surprised to see the value of the dollar eventually stall and potentially even begin to lose value relative to international currencies, which, assuming international economies and markets remain attractive, would compel us to increase our international allocations. That would be an important change that we've been anticipating for some time. But I think at this point in our conversation, we ought to transition to Brian. As clients of McKinley Carter know, these are the types of conversations we regularly have with them, but our work doesn't end with investments. In fact, some of the most valuable work we do with them is around their financial situation. Of course, investments are an important part, but I think we need to take into consideration how do our financial needs, whether it be withdrawals, investments, anticipated retirements, the need to tap into assets, current capital market assumptions. How do we take all these into consideration, the impact they may have on our situation and our portfolio? With that, Brian, I hand it off to you.
Thank you very much, David. Appreciate that look back as well as sharing of the outlook heading forward. So when we do think about how do we make this personal, and so let's try to make this personal for the remainder of the discussion, at least as personal as we can with a couple of hundred participants that we have. But I would imagine in a group of this size, some of you must be asking the question, how can I assess if I'm still on track? It would be very normal and a natural question given the changes. And so when we think about where we begin with something like that, we have to have a starting point and requirements to know if we in fact are on track. So the way that we would talk about that and would encourage you is to first revisit and organize your goals and assemble your resources. So with that is that then we can utilize some financial modeling tools to track your current scenario and compare alternative scenarios. The picture on the screen isn't intended to represent or be share information with you other than how we might look at this, where we might have a column that looks at your current scenario and what some of the projections and assumptions might be, and then try different scenarios of whether it be to live longer, to retire earlier, to sell a business, those types of things where we can test and we can see how the financial model stress test and how it performs in different situations and different scenarios. So critical, but we have to start with, of course, organizing your goals and assembling your resources. And part of why I would say that is because additionally, an assessment, if you're on track, we'll need to look at the strategies that you have to find alignment with those strategies and with your needs. For example, a common approach is a bucketing approach. And so what we mean by that in the industry is for those, of course, goals in which we've got a shorter term time horizon, such as a year or near term, is we would expect to be investing or retaining those assets in cash or cash equivalents, short term kind of holdings. And in a year in which we've gone through here in 2022, having that cash reserve or those short term assets has been incredibly valuable for people, because as we move over along the time horizon from left to the right, that's where we would expect, of course, to take on a little more risk, so that we might have, for things that might be 7, 8, 10 years out into the future, an allocation to equities or stocks, as well as bonds and alternatives, and willingness to take on that additional investment risk that might come along with it. But then, of course, as we go out to things like 15 years and beyond, is where we can take even more risk and have an even larger allocation to equities. So alignment with our strategies in this bucketing strategy with what those needs might be as we go through time. Of course, what happens is as the years pass, something that was previously a 15-year objective might now be 10 or 8 or 6 years away from realization. And so how do we move that and get it more conservative if in fact that is the most appropriate? This is where an advisor can be incredibly helpful of applying that disciplined approach. Because when we think about some of the assumptions, and this has been definitely challenged here in 2022, and some of what David just walked through, is that we think about assumptions of returns in 7 to 10 year kind of increments. And as David shared, we anticipate our moderate growth portfolios, for example, on an annual basis over the next 7 to 10 years to have roughly a 5.5% kind of rate of return, with a standard deviation of 10%. Which means in most years you would expect an annual return to be plus or minus 10% of that 5.5. So rounding 5% negative to 15% positive. As David shared with you, we've been outside the norms here so far in 2022. There's still second half of the year yet to go. But this year, not unlike 2020, may require us to review some of the assumptions that we have here. So I would encourage you to ask your advisor, have my personal investment return assumptions changed, and what do those maybe look like going forward as far as our portfolio and our current allocation of assets? So should I do something? As humans, we are naturally wired or compelled to do something. David mentioned this a little bit ago. We want to take back control and not sit idle, being a victim of things outside of our control. Now, we believe there are usually smart actions that one can take in consideration of these changing environments. Now, your smart action is likely to be somewhat unique to you. In a moment, I'm going to walk through several examples of smart actions to consider and discuss with your advisors, but let's understand the cycles we go through of human emotions that impact our desires to do something. I thought the chart or the picture represents that fairly well. And on the left side, we look at those optimistic time periods in our life that as things continue to improve, turn to excitement or thrill or euphoria. And maybe you've experienced some of those emotions, but then it starts to roll over of everything looks so good. Maybe I'm in denial of things are actually starting to turn and go through another cycle, or anxiety or fear. Maybe some of what we've experienced in 2022 can lead us down to some of the other emotions that are captured in the cycle, even down to despondency. And 2020 was a great example of this turnaround of skepticism turns to hope. As the investment markets bottomed in March and April of 2020, there was all the talk of, well, is this just a short term and then we're going to turn back down and we're going to go to lower levels than where we were before? So skepticism turned to hope, to finally, of course, relief, but questions about how can the investment markets going up when the end of the pandemic is nowhere near. But as I put circles around the dangerous times, and these are probably the two most dangerous times, where on the left in that euphoric state, it's the point of maximum financial risk. Whereas on the despondency side, it's the point of maximum financial opportunity. We don't know where we might be in this particular cycle, but as David articulated, as many of the statistics would argue that we are approaching and maybe closer to financial opportunities than anything. This is not a chart of the stock market. This is actually a picture of consumer sentiment. And so it looks at how people's outlooks and viewpoints are, emotions are. And so at high points, how is there a correlation to when people are euphoric, as we just looked previously, and what the investment market's returns are? So in August of 1972, when everyone was very positive in terms of where things are going, the stock market actually had a negative return over the next 12 months. And we see that when people were at their lowest in terms of despondency in February, is that it was, the stock market had a fantastic next 12 months. So there's not necessarily always a correlation between the two. And actually, as the box highlights, during those 8 sentiment peaks, the next 12 months, the market did about 4%, represented by the S&P 500, our 500 largest US companies, where coming off of those troughs, nearly a 25% return overall for the markets. And so it's totally understandable, the human emotions as we go through these cycles. And this is where a disciplined approach certainly can be so advantageous. So it's very normal for people to ask us, would it hurt to sell and sit out for a few weeks or months? And as many of you have probably seen the picture that is depicted over the past 20 years, had you stayed fully invested, you would have had an average return or an annualized return of about 9.4% over these 5,200 trading days over the course of 20 years. But if you had missed just the 10 best days, that cuts your return nearly in half on an annualized basis, or the 30 of those 5,200 trading days. And probably one of the most telling pieces is that missing the best days is certainly easy to do. But considering how quickly 7 of the 10 best days occurred within 2 weeks of the worst days, as you can see from the little legend that's incorporated there. So maintaining an investment and being disciplined is certainly going to be a critical component. Perfect timing. We'd all love to have perfect timing. So investing at the annual market low point. This is just a study looking at if you invested $12,000 a year every year for 10 consecutive years from 2010 through 2020, what would that have grown to, that $12,000 investment every year for 10 years? And if you were incredibly successful and you picked the absolute market low point in every one of those years to put that $12,000 to work, it grows to $315,000. But if all you did was investing on January 1st, that $12,000 every year, is you get pretty darn close to the same result because the money was invested for the entirety of the time period. And while perfect market timing is ideal, it's implausible in order for that to occur time and time again. And of course, in our industry, we talk about dollar cost averaging, and we will again here in a moment. Putting money to work on the first day of every month and how that translates and takes away some of the emotions, the desire not to invest or the desire maybe to get more aggressive at inopportune times. Even perfectly wrong timing, picking the worst possible day of the year to put that $12,000 at work isn't as detrimental as just leaving it in cash. So cash every year, $120,000 worth of deposits, get you to $126,000 or $6,000 worth of appreciation. So cash is not the long-term story, and certainly we need to continue to focus on the long-term outcomes. Briefly, bull markets when the markets are rallying, bear markets when the markets are having a struggle. So the blue represents those uptime periods. Now there are sideways or downtime periods when we've had extended bull markets in the past, or the gold representing those short-term declines. But that would be a takeaway here, is that when we do have downturns in the market, they've been relatively brief and definitely relatively shallow compared to the height of the strong upruns that we've had. But this is the trade-off. Like in everything in investing, there's a trade-off between the wins and the losses, the good times and the bads. And so when we experience times like we've had in the first 6 months of this year, it ought not to be a surprise. This is part of the trade-offs that we have in the investment markets. So what steps should I take now? So we've broken this up into 3 different categories, whether you be an accumulator, a distributor, maybe a business owner or an executive. So we start with the accumulators first. We would encourage those who are in accumulation mode to reevaluate your financial goals and probabilities of achieving them. I ask, what's been the short-term impact of inflation? How's this impacted maybe your longer-term expectations? We would also encourage you to rebalance investment accounts strategically. We have a discipline in place. We have a target of how much we would expect in a normal environment to have in certain asset classes. Now's the time to consider rebalancing those portfolios so to make sure that we have the target amount there and that we're not underweight areas in which might be the most opportunistic going forward. Harvesting tax losses. So in taxable accounts, it may be an opportunity if something is down in value to sell it, to take the loss, utilize that loss at another time later in this year or in future years if appropriate in your situation. But we would encourage you reinvesting in similar, maybe equity investments and not just sitting in cash off to the side. Setting up those systematic or even lump sum contributions, we think this is a great time to be doing that, whether it's into investment accounts, maybe health savings accounts might be available to you, defined contribution or retirement accounts, 529 plans for children or grandchildren. Great time to make additions to those sorts of holdings. We've had some fantastic conversations of exploring Roth IRA conversions with people. For your traditional IRA or retirement funds, converting those over while valuations are lower and allowing the recovery to happen within a Roth IRA may be appropriate to your situation, something to explore or talk with your advisor about. And for those who have loans, particularly variable interest rates, this may be a great time to consider extra payments or principal payments on some of those. We'll transition to distributors, and why I do that is when I think about distributors or people who are living off their assets, is you have a plan with your advisory team and an investment strategy to fall back on during times of uncertainty, and this is one of those times. And so reevaluate and visit that plan and that investment strategy, but do it in a very rational, disciplined way. So right now it would be great to reevaluate your income needs as well as your wants and your wishes and what the impact of inflation here in 2022 and maybe beyond might have on those. Like I talked about earlier, rebalancing those investment accounts, which even for distributors or people who are withdrawing may include buying stocks now. Back to that bucketing strategy, those 3 to 5 years of withdrawals of fixed income or cash, make sure that those are there in that bucket that aren't going to have the same sort of volatility, potential negative volatility of what we've seen in stocks. Consider utilizing the health savings account, contributing to or withdrawing from, either way, may be well timed in light of the volatility in the investment markets. Tax loss harvesting, reinvesting, as I noted earlier, and also to maintain a diversified portfolio. Now's a tempting time for people who are drawing and living off a part of their portfolio to sell and relinquish some of the potential future returns as the markets go through their next cycle. Given David's remarks on our understanding of those cycles and at human behavior, taking some smart actions or sometimes no action is best, but maintain that diversified portfolio. And the third category for those business owners and executives, we would encourage you to revisit your senior officers and plans for business leadership. In these times, you may find delayed retirements coming out from some of those folks. We'd also encourage you to revisit features of your company's qualified plan. Education sessions like this for your employees may be really valuable. We don't want them to stop contributing to their plan, for example. Maybe for your retirement plan committee, fiduciary best practices may be helpful for them. Unfortunately, in times like this and down markets, lawsuits become more common for such businesses that have retirement plans. Funding profit sharing contributions, depending on one's fiscal year and typical funding patterns, are there opportunities to make contributions now or in the near future? And consider a Roth conversion, whether that be to a Roth IRA or a 401k. Roth, would be things that would be unique to your specific situation and your plan if those are available to you. So those are some of the things that we wanted to hit, but my final action items for you in terms of organizing your goals. Have your priorities changed at all? Be clear about your needs, your wants and wishes in your life. You should plan on living a long time. Now, we actually have put together a worksheet that you can download to help you get started in this area if that would be a jump start for you. The second, assemble your resources, as I noted, those pre and your post-retirement income, your investments and your other assets. Harness the power of dividends, of compounding and being opportunistic. Align your strategies. Avoid emotional biases by sticking to a plan. Volatility is normal. Don't let it derail you. Diversification works. Staying invested matters. And lastly, prioritizing your tactics. Identify the specific actions that has the biggest impact on your situation, whether that be a cash reserve or some of the examples from the previous slides, or maybe things that have a time deadline which you need to address. This is something that as advisors, all of our advisory team can help you prioritize your actions or your tactics. And that's really where we wanted to take today's discussion, is towards the actions with everything that has occurred that might be most valuable, most beneficial for you and for your consideration. So lastly, today our time was limited, but in addition, of course, we have our entire advisory team that has these conversations and leads such conversations. We have several additional resources to explore. As mentioned earlier, we're going to take a very quick break to stop this recording, and we'll restart with questions and answers. Please simply use the chat function to submit those questions. There is a QR code there that you can use your smartphone to take a picture of, and it'll direct you to a segment of our website where you can learn more about case studies. All of our advisory team members are there, or to submit an inquiry through the website there if you'd like to learn more information. We are always writing and producing videos and talks about these types of things. So on the left side, you'll see the link to the MCWS blog or any of our resources that may be helpful for you in your work and your pursuit of your own financial autonomy. On behalf of David McKinley and our entire team, thank you very much for joining us and for being our client. Thank you.